Abhay Agarwal, Managing Director at Serica Advisors. Abhay, good morning and welcome to the show. A good time to speak to you because clearly if you see in terms of what's happening, a major route with regards to where the broader markets go, you have the foreign investors which have continued to pull money out of emerging markets, and it seems India is no exception. What would you have to say at this point in time? And do you think this is just a blip or a phase which will pass soon?
Yeah, good morning. I think what is happening with the FPI flows is not abnormal in that if you look at the longer term history, we have seen episodic pullouts by FPIs, a lot of money which used to be called hot money suddenly goes out because it is chasing returns in global markets. It is not India specific money. So that is the money that has been flowing out, and there are two reasons for that that I can think about. One is, of course, the higher bond yields in the US are attractive enough for US dollar investors to lock in those returns and bet that those yields will come off, and when they come off, they will make good capital gains on the US dollar bonds. So I think a lot of money is going back to the US in bonds and in stocks also. US market cap is now at $65 trillion. The second bigger issue also is, a push factor from our side, because India is an insular market. It's not that big a part of the global economy. So the attractiveness for investors, global investors, of looking at India was to look at India as a very strong consumption market, that there is a very large population that is consuming more and more, and that will drive corporate earnings for companies that cater to that consumption. Now, with a slowdown in earnings, slowdown in consumption, that thesis is being put to test, at least in the short term. So there are worries that earnings will continue to slow down, especially of companies that cater to domestic demand. So I think till domestic demand comes back, and also the US bond yields come off, till these two things happen, I don't see a reversal of FPI money into the Indian market. What it does is, of course, while you're in it in the correction phase is painful, but with a longer term perspective, it also gives an interesting investment opportunity to long-term investors who are looking to invest in Indian stocks.
Right, Abhay, an interesting point with regards to what could get the FIs back into the country. But on the domestic front, it seems that the investor confidence has remained slightly strong, because if you see the SIP and the mutual fund inflows as well, they have continued to hold steady. However, a significant portion of your household savings is still sitting in cash. I think deposits are exceeding nearly over 35 lakh crores. What would all of this mean then? Because clearly there is confidence in terms of where the DIIs are concerned. However, the markets are in a correction phase. Plus, you have the earnings expectation, which has now moved to single digits. Where would you find value now?
I think the point on domestic investors staying strong is pretty well made. And if you look at the historical context of that also, about 5% of household savings annually found its way into equity markets, 70% went into real estate, and that is changing a lot. And I think what we are still seeing in terms of domestic flows is still, we are is pretty thin compared to what it could be. So I'm not at all worried about a reversal of domestic flows, because I think investors have also learned that whatever the markets are, it's better to keep a systematic investment plan in place. So I'm pretty confident that domestic flows will continue. And what will provide opportunities, I think across the board, what we are seeing, we have been underweight in banking sector, for instance, for last 1.5 years. We didn't have any bank in our model portfolio. We just added the first bank to the model portfolio. So we are seeing some signs emerge that banks, for instance, have been beaten down beyond their fair value. So they will emerge there in insurance sector. In domestic consumption names, I think as there are signs of recovery that come in, we did channel check conversations this week where we found that cement companies are seeing good uptake. We also found that inventory levels with auto dealers are at pretty low levels now, about 15 to 18 days against 33 days normally. So I think if some demand keeps coming back, and with lean channel inventories, you will see uptick in consumption demand. So that will again drive credit offtake. So I think there are opportunities emerging, but investors will have to brace for further corrections if they are, while they are making their bets now.
Abhay, the other question, and I know that I don't want to set a question on just the Indian rupee. There is all sorts of expectations that the RBI will probably come in and perhaps set a limit at around 88 rupees, 89 rupees. As yet, it is a factor which is working against markets right now. Uh, when it comes to Trump and all the policies that we have, all the rhetorics as well that we have at the moment, how do you think that this trade could potentially pan out? Because it is something of a worrying factor at the moment for Indian markets.
I think RBI has realized that it is futile to fight the currency war, because we do not have the resources, and nor should you. You want to get to a point where rupees freely tradable, convertible, if not in near future, at some point of time. So, using your forex reserves to fight a tidal wave of a global strengthening US dollar is futile, So I think while RBI will definitely step in if there is a sharp correction in the rupee, which we saw when it hit 88 levels, and then suddenly there was, within an hour, there was a recovery of almost 1%. But I think rupee slide depreciation moving towards 90 should not be seen as an abnormality. If the US dollar continues to strengthen, if the DXY gets to 110, I mean, it is pretty much expected that rupee will get to 90. Whereas if DXY goes back to 105, 103 level, which is not looking likely right now, the rupee may stay at the current level or may strengthen slightly. But I think that is where our corporate earnings and market participants have to find comfort with that. With the rupee depreciating, there is also an opportunity to further push the agenda of domestic manufacturing for the government to look at, what are we importing that we don't need to import through PLI schemes and build as much as we can in India. And also drive exports by welcoming foreign companies like Apple and Samsung, which we have done pretty successfully to export from India. So I think this crisis of rupee, if you want to call it that, is also an opportunity in disguise for us to act on and be more self-sufficient and self-dependent.
Abhay, in the broader market specifically, there are a lot of companies out there which have corrected 30, 40% from their tops. A lot of these companies are still showing, rather expected to show growth of around 20 to 30% in their bottom line, about maybe 20% in the top line as well. But the question is that at one point in time, these companies would trade at around 70 times, 80 times, 100 times, and this is 1 year forward. Now that we are looking at a little bit of rationalization, the froth is out of the markets clearly. What is a good valuation that you may want to be okay with paying for a 30% bottom line growth, 20% top line growth?
This is a very delicate question, because we debate this internally that, look, what are the right valuation levels even for growth companies? What is, when we say growth at reasonable price, what does that exactly mean? And I think that is what your question alludes to, that there are markets which are bullish markets and people are willing to pay what they think is reasonable 70, 80 times forward multiples. We saw that a lot of new listings, especially catering to defense sector, catering to upcoming sectors, electronics, were trading at that level. And now some of that froth has come out. You're absolutely right. I think valuations have corrected, but some of these companies are still at 40 times forward, from 70 times forward. Uh, I think from our perspective, when we build our model portfolio, what we want to see is, first of all, we want to establish clear growth, because if they're catering to business to government contracts, there is delay. We have seen companies announce recently and the stocks have really suffered when there is a delay in government contracts. So we would like to stay away from those companies and focus on companies that are really benefited by a very strong tailwind, good management, good balance sheet, don't need to do QIPs, don't need to dilute, don't need to borrow to fund expansion. And then those companies become very rare. And I think that is the context. Then if you can get them, company growing at 20, 25% for next 3 to 5 years annually, and you can get it for 30, 35 times P multiple, I would make that bet, because I think India is a growth market. That is where most of the money has been made, by backing growth. So we would continue to do that. And I think this correction is again giving an opportunity for investors to do that.
Okay. And a final question then, Abhay. I know that you did briefly mention pockets of opportunity, and of course, financials and banks specifically was one of them. Are there other areas that are looking interesting to you? If not now, then maybe a correction of another 5 to 10% from here on?
I think pharma as a space is very attractive. I think with a 5-year perspective, even where the valuations are, because we see that sector benefiting squarely from a rupee depreciation. It benefits a lot from its pipeline of products that it has over the next 1 year. There are companies that have 150 new product launches over the next 1 year. US is a very receptive market to Indian generic exporters right now. So I think that is a market that, and I think that's one of the reasons that it was the best performing sector in the last calendar year. And we are expecting it to outperform this year also. So pharma definitely. And the second one I would say is insurance as a sector, again, not given enough credit, but companies that have taken leadership position in health insurance, in general insurance, in life insurance, I think will all benefit. So I think these two spaces are where we are fairly bullish as an outperforming sectors for this year.